Okay, 23, 22 so far have joined. All right, two more, three more people. All right, so I think most of you are already in here from the. Okay, let's see how. Okay, I have 25 here, including myself. Okay, so I have only like 3 bar here. If let's say I got negative, please text me. All right, at the WhatsApp group. Okay, please. Yeah. All right. We have 2 weeks break. There was a very long break. All right, and a year for everyone. Okay, so let us please ignore the noise on the background. All right, I have someone who is doing the exercise this morning, and I can't, all right. So whatever noise that you hear in the background, just ignore. Okay, you just focus on my lecture. Yeah. Okay. So here we go. Right. So this is question number 2 here. Okay, I've already given you actually question number 1. Okay, which I asked you to do during that long break, just in case you are bored. Okay, you have nothing to do. You would like to, to try out more questions on consolidation. Okay, I hope that some of you have attempted it. Okay, I will give you the solution for this after the class. Okay, so we look at question number 2 here. These are all past exam questions, all right? Past exam questions. And you will expect this is the kind of question for your group project and also for the final exam, okay? All right, so what you can see here is that, okay, when you get a question like this, okay, usually the first entity here, okay, the first entity here, this is the parent company. All right, let me switch off my let me switch off my camera first. Okay, now it's up. Okay, sorry, class. Yeah, the line got disconnected for a while. Okay, let me switch off my camera first. Okay, so you won't get distracted. Okay, we'll go to entire screen, share. Okay. So I hope I am now sharing. Okay, can you all see what is presented on the screen? Can you see?
Yes.
Yes. In case something happened, like I said, please let me know. Yeah, because I am putting up 2 solution. Okay? Right. So it's a question like this. Okay? You will know that the first entity here will represent the parent company. Okay, the first entity here. Okay, this will be the parent company. Okay, all right, and this one will be the subsidiary company. Okay, and then you must look at the financial year. This is the year you are going to prepare the consolidated, okay, statement of financial position. All right, this is the year you prepare the consolidated statement of financial position. So financial position of the individual companies is already done here, but of course you are given additional information, all right, because some of the information has not been adjusted, okay, or some of the information, okay, transaction already taken place, but it is transaction between entities in the group, and so you need to do the adjustment. Okay, all right, and then you look at this information, investment in Palam. All right, investment in Palam, this one is the investment in the shares. Okay, investment in the ordinary share capital of the subsidiary and also in the debenture of the subsidiary company. So you look for the ordinary share. All right, you can see here the ordinary share capital is 200,000 ringgit with an issue price of 1 ringgit. All right, and this subsidiary also has a 10% debenture. So you can see here there is a 10% debenture with a nominal value of 40,000. Okay, so the company invested in this, yeah, financial instruments, the ordinary share and also the debenture, okay, of the subsidiary. All right, and remember that this investment account will be cancelled, yeah, when we prepare the consolidated statement of financial position. All right. Okay, and then when you move on, okay, you will see the inventories, and then you see this loan to Palam in the book of Salam. Okay, when you see the loan to Palam in the book of the parent company here, all right, definitely there is going to be an intercompany. This is an intercompany. Okay, balance. All right, this is intercompany balance, and you will look for another balance, okay, in the other subsidiary, sorry, in the other entity, which is Palam here. All right, so you see here there is a loan from Salam, 13. This is your another intercompany. Okay, so the intercompany loan, yeah, you must make sure you do the calculation. And when you see there is a difference in the figure, the difference is due to cash in transit. All right, cash in transit, because this is a loan account. All right, so it's a cash in transit. Okay, and when you move on, all right, you will see there is ordinary dividend receivable from the subsidiary by the parent company. So again, this is going to be an intercompany. So you identify first, you read, you look through the question first, and then you identify, try to understand the question, yeah, the information given. So ordinary dividend receivable from the subsidiary in the book of the parent, meaning this is intercompany, and that means the subsidiary company here must have a dividend payable. So you can see here, there is ordinary dividend payable. All right, here, 20,000. Okay. So the subsidiary has declared, all right, a dividend payable. So again, this is an intercompany. Okay, so you remember, yeah, that your intercompany balances, you must do the cancellation. All right, and whatever balance is the dividend payable by the subsidiary to the non-controlling shareholder. Yang tu awak tak cancel. All right, it will be disclosed in the consolidated statement, yeah, as the liability. Okay, then you down to the share capital. Okay, you see here there is a non-redeemable preference share, all right, in the book of the subsidiary. Okay, so what is a non-redeemable preference share? That means this is an equity. Okay, this is an equity. All right, that means this is a share capital. Okay, and then since you can see here, the parent did not acquire, yeah, the preference share of the subsidiary, so 100% of this, okay, will belong to NCI. All right, so you will transfer, yeah, remember to transfer this portion to the NCI account. Okay, then you have the retained earnings, you have the share premium general reserves. Then you see there is a 5% debenture. Okay, so there are two types of debenture here. One interest 5%, the other one carry interest 10%. 5% is the parent, 10% is the subsidiary. Invested in the 10% debenture. All right, we must cancel this cost, 20,000 against the nominal value of this debenture, but held by the parent. Okay, so for you to determine whether there is any goodwill, from the acquisition of these debentures. Okay, right. So you go down, you will see there is a preference dividend table here. Okay, in the book of the subsidiary company. So remember just now, NCI acquire 100%, right? So there's no cancellation of the preference dividend table here because this belong to the NCI. Okay, so you study the items given, right? And from there you make or jot down, on your piece of paper, you jot down what are those things that you have discovered, okay, from the financial statement itself. Okay, so this is how you attempt the question. All right, okay, then we move on to the first step. What is our first step? It is to determine the percentage of interest. All right, that is your first step. So that is given in info number 1 here. Okay, it says on 1st of January 2016. So this is the date of the acquisition. Okay, and this date is important because the parent acquire 160,000 of the ordinary share, and this is the one that gives rise to control. Okay, so is there control or not? So we have to determine 160, okay, out of the number of share capital in the subsidiary. Okay, so it's 200,000 ringgit. The price is 1 ringgit, so there are 200,000 units. So 160 divided by 200, that's 80%. So there is a control because the parent holds 80%. Okay, so once there is control, it means you are going to consolidate. All right, consolidate, okay, the items in this statement, all right, with the item in the financial statement of the subsidiary company. Okay, so that is the importance of this criteria. Okay, and on the same date, okay, the parent acquired 20,000, 10% debenture of Palam. Okay, and this does not give rise to control. It's just an investment. Okay, in the future you want to get the returns in the form of interest income. Okay, so the amount held is 20,000 out of this figure 40,000. So that will be your first step. Determine the percentage of interest. Okay, and all this has been paid by cash. So you can see here. All right, this is the consideration transferred. Okay, all paid. Okay, so we go to our step number 1. Okay, which is not shown here. Okay, so I'm going to put down the step. All right, so we have the parent, okay, and we have the NCI, all right, date of acquisition. So Salam acquired ordinary share capital of Palam. Okay, like I said, the calculation is 160 divided by 200, 80%, and 20% is held by the parent company on 1st of January 2016. Okay. And we also acquire the 10% debenture of Palam. Okay, and how do we calculate the figure? All right, it says 20,000, and we divide that by RM 40,000. Okay, and we multiply that by 100%. Okay, so that gives us 50%. Okay, so 50% of the debentures, all right, of Palam is held by the parent company. And because this debenture is a liability, we don't have NCI, so dash. Okay, no NCI. 1st January 2016. Okay, so remember, debenture, there is no NCI. All right, no NCI because this is a liability. subsidiary also has preference share capital. Okay, but none of it is held by the parent company, so 100%, okay, is held by the NCI. All right, so this is your first step. Okay, you need to list down this percentage of interest. Okay, all right. So when you go to the financial statement, of course, we know that. Okay, let me delete all this first. Yeah. So I'm going to do sort of a revision again, okay, with all of you. Okay, you need to understand that when we prepare this consolidated statement, yeah, of financial position, it means we combine, yeah, combine each of this line item, all right, of the parent with that of the subsidiary. So in this consolidated, okay, your assets, freehold land, yes, okay, you have freehold land of the group, so you just plus these two. Okay, 340 plus 300. Other property, plant and equipment, yes. Yeah, this will appear in the consolidated, so you just add. Okay. Investment in Palam. Remember, I said all this investment we have to cancel. We have to cancel this. All right. We cancel the consideration transferred by the parent against the parent share in the ordinary share capital, and also the reserve of this subsidiary company. So if you look at the subsidiary, okay, what are its reserve? There is a retained profit, all right? There is a retained profit, and there is also a general reserve. So we need to cancel this against this free, all right, on the date of acquisition. Then you must remember that, all right, these are the free reserve that is existing on acquisition date. So we need to find that figure. Okay, we need to find the information. So you go to info number 2 here. Okay, and you can see that on the acquisition date, the retained profit and general reserve balances of Palam are 30,000 and 12,000. So that is the pre-reserves. Okay, together with the share capital. All right, but then you must also determine, yeah, that the fair value of the net asset of the subsidiary might also include other reserve. Okay, so you look for other information on acquisition date. Is there any revaluation? Okay, or any assets? Is there any assets of the subsidiary whose carrying amount, okay, is different from the fair value, and you need to do fair value adjustment? So you go to info number 3. All right. In January 2016, the fair value of the freehold land of Palam is 330. Okay, and Palam had not adjusted this in the book. So you must remember, yeah, that in the group account, okay, all the assets of the subsidiary, okay, must be at the fair value. All right, must reflect the fair value. So if the subsidiary had not revalued its assets, okay, they belum lagi revalue this freehold land. You can see here, okay, the land is still carried at the cost in the book of the subsidiary. It should be at the fair value. So you need to do fair value adjustment, right? So that will result in another pre-reserve, yeah, which is the revaluation reserve. Okay. Right. Now, other than that, okay, we might also have the asset of a subsidiary, okay, terutamanya intangible assets. All right. Subsidiary may have internally generated brand, for example, here, internally generated brand, okay, which the subsidiary cannot recognize. They tak boleh recognize the internally generated brand. But on business acquisition, because this is a business acquisition, yeah, the parent company acquired the brand. So this becomes an acquired brand for the group, all right, of the group. So once it becomes an acquired asset, okay, you have to recognize this as your IA, yeah, in your group account. So it is valued at 20,000. So because it happens on acquisition date, that is going to increase the fair value of the net assets of the subsidiary. So your pre-reserve now will increase. All right? Okay. So we need to do the calculation of goodwill. So we need to cancel this cost. Okay, this cost we cancel against the fair value net assets. All right, in order for us to determine the goodwill. Okay. Now, what else affect calculation of goodwill? Then you must remember, yeah, ada satu lagi perkara yang affect calculation of goodwill. That is the bonus issue. So you have to look for information on bonus issue, which is found in info number 11 here. All right. So the company here, subsidiary, has declared a bonus issue. And that bonus issue is made up of the pre-general reserves. So that is definitely going to affect the calculation of goodwill. All right. So that's how you plan your answers. Okay. All right. You need to do cancellation of this investment account against the fair value net assets to calculate goodwill. Okay. And there are a few information that affects computation of goodwill. All right. One is the fair value adjustment. The other one is the bonus issue, right? Okay. So this account will be replaced with goodwill. Now, what about investment in debenture? Investment in debenture, the cost here will also be cancelled against the nominal value of, okay, the nominal value of this debenture held by the parent. Okay. So parent that he held how many percent? 50% of this, right? Okay, so you will cancel 50% of this against the cost. Okay, again, for you to calculate if there is any goodwill. Okay, from the investment in debenture. All right, so this will be cancelled. Okay, replaced with goodwill if any. All right. Okay, what about inventories? Yes, yeah, your group will have inventories which you will plus here. Okay, combine. Loan to Palam. This loan account, cancel. You have to cancel this. All right, so this 15,000, all right, will be cancelled against this figure of 13,000. And it is also mentioned in additional info number 8 here. All right, that on 30th of December 16, Palam had remitted 2,000 on account of the loan, but Salam only received it on the 2nd of January. So there is a difference. Okay, dia dah bayar 2,000. Okay, yang sini sebelah ni dia belum terima lagi. That's why balance dia masih outstanding at 15,000. Okay, so what is the adjustment for this? What is the adjustment for this? Okay, so let's go to info number 8 here. Okay, we go to info number 8. All right, and we do cancellation. Yeah, how do we cancel the loan? So we debit the loan, okay, which is the liability tadi, okay, the liability account. Okay, we cancel 13,000. Okay, and we recognize the cash in transit. Okay, 2,000. And we cancel the loan asset, 15,000. Okay. So that is our adjustment, yeah, for this intercompany balance. So when it comes to your consolidated statement, all right, you are going to minus this. Okay, so this one will be minus 15. You see? All right. Okay. So in your bank account, all right, in your group bank, okay, your bank here of course will be included, bank of parent plus that a subsidiary. Okay, then you add on your cash in transit. So you plus here cash in transit. Okay, this one tadi kita dah tolak 15. Alright, so we take out the 15, so this loan account will be cancelled. Okay, right? Okay, and here we add our cash in transit. Okay, trade receivable, yes. Okay, the group will have trade receivable, which is parent plus subsidiary. Yeah? So you just combine. Bill receivable, yes. Okay, you just add. All right. Next one, dividend receivable. Dividend receivable, this is an intercompany, so we need to cancel this. So we minus this 16,000. All right, against the dividend payable here, which is 20,000 here. This one, okay, after we combine the payable of the parent with that the subsidiary, this 20,000 we minus 16. Okay, because this represent the intercompany. I'm sorry, yeah, every time I write it down here, I draw the item here, it will disappear because I'm using this comments icon here, which results in the thing to disappear. Yeah? So you just take note. Okay. So what is the adjustment for this? The adjustment would be, okay, it's information number. It's not mentioned in any of this additional information, but you can see from here, all right, that we need to do the cancellation. Okay, so I'm going to show you the cancellation, okay, for this. How do I get rid of that? Okay, so I'm going to do cancellation of this. Yeah? So I will debit, okay, the ordinary dividend payable, all right, by S, by Palam, okay, which is a liability. Okay, the amount cancelled is only 16,000. Okay, and I'm going to credit the ordinary dividend receivable. Okay. By Salam, which is an asset, right? 16,000. Okay, so this is the adjustment to eliminate intercompany balances. Yeah, so we minus this, all right? We credit the receivable, so we minus, and this payable, we also minus the same amount. We debit the payable, yeah, 16. So you only need to do cancellation. Once you have identified these are the intercompany balances, you just do the cancellation. Okay, so you can see here in the solution, okay, the effect that ada dalam schedule, it doesn't affect the schedule, it affects the item in the financial statement. Okay, so you can see here, the ordinary dividend receivable is gone. Okay, it's not shown here anymore. All right, this is already cancelled, but you can see here the ordinary dividend payable, okay, which is 30 plus 20, and we minus 16. All right, and so we get the figure, which is 34,000. Yeah, 30 plus 4. Yeah, so we get this figure here, 34,000. Okay, you can see the cancellation. All right. Okay. So this one is cancelled. Then we go to the ordinary share. Okay, ordinary share, of course, it will appear in the consolidated accounts, yeah, financial statement. But you see the share capital of the subsidiary already cancelled. Yeah, so what remains is the share capital of the parent company only. Okay. The 10% redeemable preference share, this one is cancelled as well. Yeah, because this will be credited to the NCI. Yeah, it belongs to the NCI. Okay. Your retained profit, your share premium, your general reserve, all this will be shown in the consolidated accounts, and you need to calculate, okay, by preparing the schedule. Okay. Before your liability, you must include here your NCI. All right. So you are to recognize and measure the NCI. Okay. Now the 5% debenture, this one definitely will be included. The 10% debenture, 40,000, we cancel only 20,000. So if you look at the solution here, okay, you see the 10% debenture of the subsidiary, 40,000, we minus the parent's interest. So the balance not held by the parent will become the liability of the group. Okay, make sure you cancel out the parent's interest. So that's the intercompany. Okay, so whatever debenture not held by the parent, it will become the group's liability. Okay, all right. Trade payables, yeah, of course, trade payables will be included, right? So you just plus. Bills payable, yes, you just add. Okay, ordinary dividend already done. Preference dividend payable. Okay, this figure no need to cancel, so it will become part of the group's liability. Okay, so you can see here, right? This is the preference dividend payable. It will be the group's liability. Okay, no need, no cancellation required. You only cancel if the parent had a share, okay, in the preference share capital. But since parent did not, so 100% will be recognized as the liability of the group, okay, NCI portion. All right. So that is our consolidated statement. Yeah, so you can see here, you can actually begin by preparing the consolidated statement by adding all those items and put in, all right, goodwill, okay, under your non-current assets, and then you put in your, okay, a line for your non-controlling interest. Okay, you can just add all those items first. Okay, and after that, then you can start with your calculation for your goodwill. Okay, let's go to the calculation of goodwill. Okay, all right. So I'm quite sure you have already started with this, so now it makes it easier for me to explain. Okay. So let's look at the calculation of the goodwill for the ordinary share capital. Okay, so we can see here the consideration paid. Yeah, consideration paid for the ordinary share is 210. Okay, we plus with the NCI and calculate this NCI, okay, based on proportionate share of the fair value net assets. So we need to calculate the net asset of the subsidiary, which is the ordinary share capital here. Okay, plus all its pre-reserves, which is mentioned in info number 1 here. All right, the retained profit 30 and the general reserve 12. Okay, and on top of this retained profit and general reserve, we also need to include this revaluation reserve, all right, which is for the land. Okay, so let's take a look at this one, right? Okay, so on the date of acquisition, okay, the fair value of the land is 330,000, and you compare that to the cost. Okay, so even though this date is 1st January 16 and the cost given here is 31st of December, but you know this land is not depreciated, right? So on 1st of January 16, the value of the land will still be at 300. Okay, so 300. Okay, so that results in a revaluation surplus of 30,000. Okay, 30,000. So we are going to debit the land of Palam, all right, and credit the revaluation reserve. This is a pre-reserve. Okay, so pre-reserve means it will go to the fair value net asset, yeah, for the calculation of goodwill. Okay, so this will go to the fair value net assets, yeah, for the calculation of goodwill. All right. Okay. So we go to our consolidated statement. Okay, our schedule. So we'll include revaluation reserve 30 here. Okay, that is for the land. All right. And when you go to your consolidated statement of financial position, okay, now you can add, all right, plus 30,000 to your land. Okay, debit your land. So plus 30. Okay. All right. And then you go to your goodwill calculation, the fair value net asset for the subsidiary also increases. Okay, 30,000. Right. Okay, number 4, on the same date, okay, there is an internally generated brand and that becomes your intangible asset valued at 20,000. So the journal entry is debit your brand, okay, 20,000, and credit your revaluation reserve, which is also a pre, so this will be included in the fair value and asset, okay, of the subsidiary, yeah, for the calculation of goodwill. Right? And it says that the brand has an indefinite useful life, so that means there is no need for amortization, okay, there is no amortization needed, right, since the useful life is indefinite. Okay, right, so we go here. Okay, you can see here we plus another 20,000 to the fair value net asset, and our asset, yeah, the group asset will have an intangible asset brand of 20,000. Okay, right. Now, like I said, our goodwill computation will be affected if there is a bonus issue. So I'm going down to info number 11. Okay. So here on 31st December 16, Palam declared a bonus issue of 10,000 ordinary share at 1 ringgit each to the existing shareholders on the 1st of January 2016. The bonus issue was to be made out of the pre-general reserve. Okay, so okay, when there is a bonus issue, what happens is our share capital will increase and the general reserve will reduce. So we debit the general reserve pre, yeah, of Palam, right? And we credit the ordinary share capital, yeah, of Palam, okay, with the bonus share. So it says that the bonus share is 10,000 at 1 ringgit each. So it will be 10,000 multiplied by 1. Okay, so the bonus issue is 10,000 ringgit. Okay, so this will be reflected in our computation of goodwill. Yeah, remember, yeah, the bonus issue here affects the calculation of goodwill. So in our goodwill calculation, yeah, your ordinary share capital, you plus 10. Remember, we credit the share capital means you increase it by 10,000. The general reserve is debited, minus 10. Right, so now the pre-reserve is 2,000, the share capital increased to 10,000. The effect is that, all right, the goodwill or the bargain purchase remains the same, okay, before the bonus issue. All right, so the only adjustment is here at the net assets. Okay, so with that, we can now calculate the fair value net asset, which is 292. Okay, so NCI will be 20% of that, which is 58,400. Okay, So our total net asset figure, the total of A here will be 268,400. Right, 268,400. Oh, it's already given there. Okay, never mind. Okay, this is the figure, 268,400. We minus with the net asset. So since A is less than B, A less than B, yeah, so we have a bargain purchase. Okay, and this bargain purchase will be credited to the group retained earnings. All right, you will recognize this gain to the group retained earnings. So in other words, yeah, there is no goodwill here. Okay, no goodwill from the investment in ordinary share. Okay, tak ada goodwill, yeah. We have a bargain purchase instead, and that bargain purchase goes to the group retained profit. All right. Okay. So when we do the cancellation of our investment, all right, the retained profit will go to your schedule here. So when you prepare your schedule, okay, the retained profit will be credited to the group retained profit. So you can see there is a transfer here. All right. So the retained profit will be transferred to this column. Yeah, your group retained profit. Okay. All right. Now, what about the investment in debenture? We also need to calculate the whether there is a goodwill or not. All right. So the consideration paid to acquire the debenture. Okay. 20,000. Remember, there's no NCI, so we minus the nominal value of the debenture, which is this one. Okay, the nominal value is 40, but the parents' share is only 50%, right? Okay, 50%. Okay, so that will be 40,000 times by parents' interest. Okay. So again, okay, there is no goodwill arising from the acquisition of this debenture. So there's no goodwill. Okay, so no goodwill. All right. Okay. So in the exam for your group project, yeah, make sure that if the parent invests in the ordinary share, preference share, debentures of the subsidiary, you need to compute, okay, the goodwill, whether there is any goodwill or not. Okay, because like in this case, instead of goodwill is a bargain purchase, and bargain purchase will be a gain which is credited to the retained earnings. Okay, and for the investment in debenture, it is acquired at its par value. That's why there's no goodwill. Okay, all right. So we are done with the calculation of goodwill. Okay, so now we have to look into other adjustments. All right, and those other adjustment, okay, from the transactions here. Okay, so we move on to information number 5 here. All right, we're done with 1, 2, 3, 4. We go to number 5. Okay, during the current year, Salam purchased a machine with a carrying amount of 30,000 for 60,000. Okay, so the selling price is 60, the carrying amount is 30. So there is a gain from the sale. The remaining useful life of the machine is 10 years. So this is our intercompany. Okay, this is an intercompany sale of depreciable asset. Okay, so what are the adjustments? Number 1, you need to cancel unrealized profit. You need to do elimination of unrealized profit, okay, on the sale of the machine. Why is the profit not realized? Because the machine is still used by the parent company. Meaning, if you go to Salam here, okay, the PPE included in here is the machine. It's still used by Salam, okay, as it's for its business operation. So there is no real sale. So whatever profit made by the seller need to be eliminated. All right. So the profit was made in the current year, and that profit was included in the retained profit here. That one perlu kita buang, ya, perlu dibuang. Alright, so how do you cancel the profit? So you will debit. Okay, I'm using a short form. Yeah, URP here means unrealized profit. Unrealized profit on the sale machine. Okay, and that profit, okay, is in the group retained profit. All right, that means you have to go to the group retained profit, yeah, the schedule, okay, and adjust, okay, the profit. Whose profit? So you must know who is the seller. Who is the seller? The seller is Palam. All right, Salam bought from Palam. So the profit is in the book of Palam. So it has to be the retained profit of P. Right? You need to adjust the retained profit of P. How much is the profit not realized? 30,000. Okay? 60 minus 30. Yeah, 30,000. So if you take out the profit, okay, from the book of Palam, then of course, if you take out the profit here, right, from Palam, that means the machine here, which is recorded by Salam, the machine, you must also adjust the cost of that machine. All right? So you credit. So you have to credit the machine. Okay, 30,000. Right? Jadi kita buang profit yang telah diambil kira ya dalam retained profit of the seller. Lepas tu machine, alright, yang di dalam buku, okay, buyer ni perlu di adjust juga ya. Kita perlu tolak ya the profit that was included in its cost ya, 30,000. Right? Now what would be the next adjustment? The next adjustment is depreciation. Okay, because the machine, yeah, because Salam tadi, okay, this company would have provide depreciation on the machine. All right, and so the depreciation is over provided compared to the depreciation of the group. Okay, so here we have depreciation that is over provided. Okay. Because the depreciation is based on 60. All right, for the group, the depreciation should be based on 30,000. So it was over provided by the buyer. All right, so how much is it over provided? So you just take the unrealized profit of 30,000 and you divide that by the remaining useful life. The remaining useful life is 10 years. Bagi je dengan 10. So the unrealized profit per year is 3,000. Okay, per year. Or you can take this 60, divide by 10, 30, divide by 10, then you look at the difference. The difference will still come to 30,000. All right, the easiest is you just take the unrealized profit figure, you divide by the remaining useful life. Okay. Now, since the date of the sale is not given, okay, it's important that you look at the depreciation policy. Here it says a full year depreciation. So it doesn't matter whether the sale was made middle of the year or towards end of the year, you still need to give it a full year depreciation, which is 3,000. Right. So what is the adjustment now? If the depreciation is over provided, then you have to reduce the depreciation. So when you reduce depreciation, you have to credit. Okay, credit the depreciation expense. All right. And you debit the accumulated depreciation of the machine. But since, okay, you go up here, yeah, you see here the property here is not carried at cost, yeah, it's carried at its carrying amount. All right, so we don't have accumulated depreciation. So instead, you can just debit, yeah, the machine, okay, at its carrying amount, right, 3,000. So this one, okay, this one will go to the consolidated statement of financial position. Okay, that will go to the consolidated statement of financial position. Okay, and this one, okay, since it's expense, it will go to the group retained profit, right? Okay, group retained profit. Now, because this is an intercompany sale, as the asset is depreciated, yeah, by Salam, as the asset is depreciated, portion of the profit will become realized to the seller. So we must adjust the retained profit of Palam. All right. So the profit here becomes realized through the depreciation. Okay, so this one will be adjusted to machine and another adjustment to the retained profit. All right. 3,000. Okay, now let's take a look at the adjustment. Yeah, we incorporate this adjustment into here. So we start with number 1. Okay, so we go to the statement of financial position. Okay, this is our PPE machine. All right, we credit machine. You see here, we minus 30 credit, minus 30. And then we go to the retained profit, right? To the group's retained profit. But we don't show our working here. All right, we go to our schedule. Okay, so we go down to the group retained profit. And here it says, whose profit are we going to adjust? Profit of Palam. So we go to, okay, retained profit of Palam here. Okay, it's profit at the end of the year. All right, minus the profit on acquisition date. Then you can see here, there is an adjustment for URP. Okay, minus 30. Okay, asset reduced, retained profit also reduced. All right, minus 30. The next adjustment is for depreciation. So again, I go back to my consolidated statement. Okay. Here is a debit to the machine. So you see, because the depreciation was over provided, we need to reduce the depreciation. So the carrying amount of the asset increased, plus 3. Okay. The other adjustment is to the retained profit. Yeah? Asset increase, the group profit here also increases. So you go to your schedule. Okay, you go to the column retained profit of Palam. Okay, you can see here, plus 3. Okay, so you plus 3. So in other words, okay, your PPE plus 3, your retained profit here also you plus 3, but you need to identify whose profit, yeah, to be increased, right? And so that is the adjustment. Okay. Now let's move on to number 6. During the year, Salam sold inventory to Palam for 90,000 at a profit of 20% on the selling price. Okay, 3/4 of this inventory still remain unsold by Palam. Okay, I'm going to move this down. Okay, as there is not much space left. Okay, all right. During the year, Salam sold inventory to Palam for 30,000. So who is the seller? Yeah, the seller is Salam. Yeah, so we need to make adjustment, okay, for the unrealized profit. Is there any unrealized profit? Yes, when the inventories are not yet sold by the end of the year. So you can see here, it says 3/4 of this is not yet sold by Palam by the end of the year. So the profit is not realized. Yeah, okay, the profit is not realized yet. Okay, so let's go to the adjustment. Right. So this is intercompany sale of goods. Okay, what are the adjustments? Okay, the adjustment is you only need to do elimination. You need to eliminate unrealized profit on the unsold goods. So if you see there is goods not yet sold by the end of the year, okay, whatever profit on that need to be cancelled. So let's look at the calculation. Yeah? How do you calculate the unrealized profit? Okay, so first you need to know what is the value of the inventory not yet sold. Okay, it says here 3/4, so 3/4. Okay, of this inventory, which one? This one. Sold inventory for 90,000. Okay, so 90,000. Okay, so this is the amount that is not sold. Yeah? 3 divided by 4 times 90. So unsold goods is 67,500. What is the profit on this? So to calculate the profit, you go to this information. Okay, it's a profit of 20% on the selling price. So profit on this is 20% over. So since it's on selling price, this is selling price. All right. So that means it's 100% over 100. If this is on cost, then it will be over 120. Right. So the unrealized profit is 13,500. Okay. Right. Now, once we have calculated the figure here for the unrealized profit, let's do the adjustment. So we are going to cancel the profit on the stock, right, on the inventory. Okay. And that profit, where is it? Where is the profit? The profit is in the retained profit here of Salam, right, the seller. So we are going to debit the unrealized profit, and that will go to the group retained profit of the seller, Salam. Okay, remember, yeah, we're going to adjust the seller's retained profit. Okay, 13,500. Okay, so if there is a profit that is adjusted, you also need to adjust the account of the buyer, which is the inventory here. Okay, so the inventory need to be reduced. So we will credit inventory. Okay, and of course this will go to the consolidated statement of financial position. Okay, so in our group account, right, so let's go to our group accounts. Let us do the adjustment, yeah, based on this. Okay, we go to our current assets, yeah, the group current assets inventory. Okay. So you can see here the group inventory here will be reduced by 13,500. Yeah, credit. All right, and when we reduce the asset, we also reduce our retained profit here, our equity. Okay, but whose retained profit? You go to our schedule. All right, it will be the retained profit of the seller. The seller is Salam here. Okay, so you can see. Where is it? Wait, Salam, yeah, this one. Okay, the holding. Yeah, the retained profit of the holding minus with the unrealized profit. Yeah, 13,500. Okay, right. Now we move on to the next transaction. Okay, we go to the next transaction, that is bills. All right, it says here that the bills payable of Palam was drawn in favor of Salam. So we have bill payable. Okay, bills payable here. All right, of the subsidiary. Okay, is drawn in favor of the parent company. That means subsidiary owing parent. Yeah, subsidiary owing parent. So parent will draw a bill receivable. All right, so that will be an element of intercompany bills. But you have to remember, yeah, that for these bills, okay, we only cancel the undiscounted bills. Okay, so for intercompany bills, we only cancel or eliminate the undiscounted bills. Okay. So how much is the bills that is undiscounted? Okay, so we read here, yeah, it says Salam had factored 8,000 of the bills. Okay, so that means daripada amount jumlah ya that Palam owe with the parent use transfer 8,000 of this bill to pay its own creditor. Okay, so Salam ni dia ada bill receivable dengan Palam ya. Okay, dia gunakan 8,000 daripada bill tu untuk bayar dia punya own creditor bill payable. So that means now, okay, the bills, okay, owing is no longer with the parent, yeah, but it has been transferred to other parties. So the 8,000 here is no longer intercompany. All right, how much is intercompany? So the undiscounted bill is only 15,000 minus 8. Okay, 15 minus 8, that's 7,000. So we only need to cancel 7,000 of the bills payable, not 15,000. All right, not 15, but 7,000. So we will debit, yeah, the bills payable, yeah, which is the liability. We cancel liability, so we debit. And we cancel our asset, which is our bill receivable. 7. Okay, so that is our adjusting entry. Now let us take a look at our financial statement. Okay, so you can see these two. These are our asset and liability. So dia tak ada kesan to the schedule here. Yeah, do not do anything to the schedule. All right, because it does not affect, yeah, the retained profit, the share premium, and so on. Okay, it only affect the asset and the liability. Okay, so we go to the liability bills payable here. All right, so we cancel our intercompany portion, 7,000. And then we go to our bill receivable. Okay, we also cancel the same amount, okay, from the group's bill receivable. All right, okay, so that is our journal entry. Okay. Now we go to number 9. Okay, number 9. Now on 1st of July 16, okay, 1st July 16, yeah, ingat this is beginning of the year. Salam, 1st July, what is the financial year? Oh, sorry, 1st July is during the year, okay, middle of the year. Salam issued 50,000, 7% redeemable preference share. Okay, this is redeemable preference share. All right, this redeemable preference share is, okay, redeemable preference share is treated as a liability. Okay, so the preference share capital, even though it's called a share, yeah, share, but this RPS is treated as a liability. Okay, and because it's a liability, therefore any dividend, okay, that is declared on this share is treated as a finance cost. It's like an interest expense. Okay, so you must remember this, yeah. Okay, the general principle, yeah, to treat redeemable preference share is as a liability. So therefore, this 7% here, all right, this 7% here is actually treated as a finance cost, all right, as an interest expense. Okay, Right. So the dividend on these shares was still accrued at the end of the year and no record were made by Salam. That means Salam had not recorded the issuance of these shares. So you can see here, you go up, okay, you go to the equity portion here. All right, you see Salam, there is no redeemable preference share because it's not been recorded. So you have to record this in the group account. All right, so let's go to this. Okay, to record the issue of redeemable preference share, yeah, by Salam. So you will debit. Okay, what do we debit? If the company issues shares, okay, for cash, so you will debit the cash, right? Okay, cash from bank, okay, of the group. Okay, 50,000, and you will credit the 7% redeemable preference share. Okay. So this two doesn't affect the schedule. Okay, so you don't go to the schedule because it doesn't affect anything in the schedule. It affects only the assets and the liability. Okay, so the first one is debit your cash. So you go to the bank account here, all right, of the group. So you plus 50. Okay, and then you go to the 7% redeemable, which is your liability. Okay, so you treat it as a long-term liability. So you have your 7% redeemable preference share, okay, together with the debenture, yeah, 50,000. All right, asset increase, liability increases. Okay. Next one is, because this is a liability, so there will be a interest paid, on this preference share. Okay, so we move on to the next one, right? The definition of interest expense, okay, which is 7%, 0.07 times RM 50,000. Okay, now since the issue of the preference share was 1st of July, all right, so the interest will be for only 6 months, so times 6 over 12. Okay, so all right, so that will give you a total interest for the year 0.7 times 50 divided by 2, 1750. 1750. That is the interest. So how do you recognize the interest on this preference share? All right, so you will debit interest for your finance cost, interest expense. And that will expense the charge. You will charge that to the group retained profit, right? To your profit, to your group profit. Okay, whose retained profit? Okay, the preference share belongs to Salam, right? So it will be Salam 1750. Okay, and we credit. Okay, and here it says it's still accrued, right? So you have your accrued interest, or you can use the term interest payable. Okay, all right. You can use accrued interest, or you can use the word interest payable. And this will go to the consolidated statement of financial position. Okay. Right. So let's look at the adjustment here. Okay, we start with consolidated statement. So we go to current liability. All right. So in the current liability, there will be interest payable. Okay. Right. Interest payable. Okay. So plus 1750. All right, so we add the interest payable, okay, to the group, yeah, 1750, and then we go to the retained earnings here. All right, so the effect is at the liability and the retained earnings. So we go to the retained earnings. Okay, liability increase, retained earnings should reduce, right? So whose retained earnings? So we go to the schedule. Okay, we look for the retained profit of Salam. Okay, and you can see that the interest payable minus, yeah, retained profit for Salam reduce 1750. All right, you can see here debit retained profit of Salam minus. Okay, so that is your adjustment. All right, now we move on to next item. Interest on debentures payable 31st of December. So here we go up. Okay, we don't see any interest on debenture. Yeah, that means they have not recognized, yeah, the debenture interest. Both parties have not recognized. Okay, the parent interest is 5% of 80,000. Okay, as for the subsidiary is 10% of 40,000. Okay, so both interests had not been recognized for that year. Okay, so we go here. All right, let us look at the interest accrued. Okay, for Salam. Interest accrued for Salam will be 80,000 multiplied by 0.05, which is 4,000. That is the amount of interest accrued, yeah, for Salam. Now, what about the interest accrued for Palam? That would be 40,000 multiplied by 0.1, which is also 4,000. Okay, which is also 4,000. All right. Okay, now don't forget, yeah, don't forget, you go up to your here, all right, that Salam had invested in the debenture of Palam 50%. So it will be entitled to the interest here. All right, 50% of that 4,000, okay, must be recognized. All right, so we have to recognize Salam's share of the interest income, yeah, from Palam. So how much is that? Okay, so we take 4,000, okay, multiplied by 50%. So Salam interest is 2,000. Okay, 2,000. All right. So how are we going to recognize this? How are we going to recognize these transactions? Okay, so I'm going to start with this one first, Salam. So I'm going to go here. Yeah, the double entry to recognize this accrued interest is we debit the interest, and the debenture interest, expense. And expense we charge to the group retained profit, right? To the retained profit, the schedule. Now, which profit? So the profit will be Salam. 4,000. Okay. And what would you credit? What account would you recognize? If you recognize an expense but you haven't paid for the expense, then you will have your interest payable. That would go to the consolidated statement of financial position. Okay. So let me just show, the adjustment here. Right? So in our consolidated statement, our interest payable, these are our current liabilities. So we go to current liability. Okay, you see here, interest payable 4. This is the interest payable by Salam. Yeah, so we recognize 4,000. Okay, and then we go to the retained profit here. All right, to the retained profit. So for profit, we have to go to the schedule. So we go to the retained profit of Salam. Okay, all right. You can see here interest on the debenture minus 4. Yeah, interest on the debenture minus 4. All right, debit the retained profit minus the retained profit. Okay, and that is all, yeah, for the parent company. For the subsidiary company, let's take a look. Okay, so we do the same. We recognize the interest accrued, yeah, for Palam, which is to debit the interest expense. That will go to the retained profit of Palam, 4,000, and credit the interest payable. Okay, that will go to the consolidated statement of financial position, 4,000. Okay, right. So you can see that adjustment here. Okay, you will see that under the current liability of the group, yeah, we recognize another 4,000 interest payable by the subsidiary company, and the retained profit of the subsidiary will also be reduced here to reflect the interest charge for that year. So you go to Palam, you can see there is an interest minus, yeah, 4,000. Okay, now what about this one? Recognize share of income. To recognize the share of income, we debit the interest receivable, okay, from Palam, right? And that will go to the consolidated statement of financial position, 2,000. And we credit the interest income. Okay, interest income from Salam, and that will go to the group retained profit. But whose profit? Salam. Okay, 2,000. Okay, so Salam will recognize income, credit the income to its profit, and we recognize the receivable because they haven't received it. Yeah, so it's a receivable, 2,000. Okay. So we go to the statement here. All right. Okay. And you see here there is a debenture interest receivable, 2,000. And we go to the retained profit of Salam. Yeah. Okay. Of Salam, we recognize the income received, interest received, 2,000 here. Okay. Interest income received from the subsidiary, 2,000. Okay. Now these two are intercompany, isn't it? All right, the dividend that the interest that you receive here from the subsidiary, the receivable here, okay, of 2,000 is an intercompany balance with the interest payable here. So we need to do cancellation. So in our group account, right, we need to cancel intercompany interest. So we will debit the interest payable, 2,000, and we credit the interest receivable. Okay, so that will cancel out the intercompany balances. So you can see here, all right, your interest payable minus 2 here. Okay, the minus 2 from the 4,000, you take out the 2,000, and your interest receivable minus. So there will be a zero balance, right? Okay, so that is the adjustment. All right, we have already done the bonus issue. Okay, 12, nothing. 13, impairment for the current is to make at 10%, if any, but we don't have goodwill, so No adjustment for info number 13. All right. Okay, so now we can look at our consolidated statement. Okay, we have done all the adjustment to our consolidated statement of financial position. Yeah, all the adjustment already taken. Okay, so now we look at our schedule, right? Schedule for our group retained profit. Okay, let's look at the retained profit of the subsidiary. Okay, we start with the retained profit uh, here. Okay, this is the retained profit of the subsidiary, 100,000. All right, that's the retained profit of the subsidiary, 100,000. Okay, so that's the figure. All right. Minus with the retained profit on the date of acquisition. Okay, we have to make sure that we minus the pre-profit. Yeah. Okay, so we get the pre-profit from here. Yeah, 30. Yeah, because we need to get the post-profit. Then we adjust that post-profit with the unrealized profit on machine, the depreciation, and the interest. This is the adjusted post-acquisition profit, which will be distributed to NCI 20%, parent 80%. Okay, then we look at the retained profit of Salam. Okay, this is the retained profit of Salam, 150. All right, we have looked through all the adjustment. So this is the retained profit of the holding at the end of the year. So we combine the retained profit of the holding with that of the subsidiary, okay, to get the group retained profit. Okay, next we look at the other reserve. Okay, we have the share premium here and also the group general reserve. Okay, so let's go to general reserve. Okay, general reserve of S. Okay, S subsidiary here, Palam. Okay. And reserve is 45. Okay, 45. Okay, right. That is the general reserve at the end of the year. Okay, don't forget that your general reserve end of the year, we had already utilized for bonus issue, yeah? All right, because this 45,000, okay, let me just explain this part, yeah? Because some students, they get confused when it comes to this. Okay, the general reserve of Palam, all right, on 31st of December, okay, 2016, yeah, 45,000. Okay, this 45,000 comprise pre and also the post, right? Pre and post. Okay, and the post general reserve was actually 12,000, right? The pre, sorry, is 12,000, and the post will be 45 minus 12, that will be 33. Okay, so out of this figure, we took out 10,000 for the bonus issue. So that's why this 45,000 today, you must minus the 10,000, yeah, for the bonus issue. All right. So you see 45, we minus 10. Okay. To adjust the retained profit at the end of the year. Since this is a subsidiary, okay, we need to get the post reserve. To get the post reserve, you must minus the pre. And what was the pre-reserve? You go up to the goodwill here. Your pre-reserve is 2,000. Okay, after you utilize the bonus issue, the pre-reserve is 2. So minus 2. So you have a post-acquisition general reserve of 33. This is the one. You see, you must get this 33 as your post-reserve. Okay, if you don't get 33, means your answer is wrong. All right, so your post-reserve should be 33. Then you allocate 20% to NCI and 20% to the parent company. Okay, and to calculate the group's reserve, all right, it will be the general reserve of the holding plus that of the post reserve from the subsidiary. That's your group general reserve. Okay. And for your group share premium, there is actually no need for you to show the calculation because there is only share premium of the parent company. Okay, so you just transfer this 50,000 to the group. Okay, so you can see here. All right, the group share premium 50. No need for any calculation. Okay. Now let's take a look at your NCI. So finally, then you can calculate the NCI portion. Okay. So NCI value on acquisition date, you just take this figure. Okay, this is the NCI value on acquisition date. You just transfer to the NCI column and you add with the NCI share of the preference share capital of the subsidiary. Remember, 100% of this, okay, is held by the NCI. All right, and you plus with NCI share of the post reserve. Okay, so you get 142. All right, so all this figure you just transfer to your consolidated statement. All right, so that's it. Yeah, that is your consolidated statement of financial position. Now, so far, all right. Any comments? Anything that you would like to share regarding your